Hello, everybody, and welcome back to AGX Media. Joining us today is Nick Barisheff, the author of $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. He's also the founder, president, and CEO of Bullion Management Group, Incorporated. Highly recommend checking them out at bmg-group.com. Nick, thank you for joining us.
Well, thank you for having me.
So let's start off with your bold call here for $10,000 gold. Please outline us the path that takes us from here, where we are today, to that $10,000 mark.
Well, first of all, I wrote the book in 2011, and I sounded like a lone wolf in the wilderness because nobody was saying $10,000. But now it's like a conservative estimate because there's serious analysts that are talking about 15,000, 40,000, and so on. But the main conclusion of how you get to 10,000 is the fact that up until 2011, gold in U.S. debt, price of gold in U.S. dollars in U.S. debt was like perfectly correlated. And then it diverged in 2011. Yeah, U.S. debt kept going up even at a more rapid pace, and gold fell back. There was a lot of reasons, and it's, to me, pretty clear there was manipulation at various levels. So at this point, to get back to the sort of the normalized mean, you would need $2,500 gold today. In the future, so far the central banks of the world have printed record-setting amounts of money in 2019. But that is going to be like a drop in the ocean compared to what they're going to print. Because so far the money was paid to people not to work and supporting businesses to be closed down. Eventually they're going to have to inject a lot of money to get people back to work and businesses going. So my expectation is next year alone, we're probably going to see 4 to 10 times the amount of money that was printed in 2019. So the gold price will go up dramatically. The question is timing. The thing is, you've got clearly a manipulated market. It's being manipulated since I started in 1998. So it depends on the effectiveness of that. But at some point, they're going to lose control of the manipulation. And then you can have a very rapid increase, like almost overnight. So that can happen on Comex, for example. There's 100 paper ounces for every 1 ounce of physical, that type. So at any month, you're going to have a Comex default.
I couldn't agree more with that assessment. I mean, we even saw a little bit of that this year when COVID initially hit. We saw the demand for metals to go through the roof for the physical metals, and they were having a hard time keeping up with it. And there was a big difference between what spot prices were and what physical metals actually cost to obtain. So
yes, exactly. Yeah. And the thing that we've focused a certain amount on is we've been just, promoting a bullion ownership to pension funds. And we sold one pension fund in Canada. Now, it's a sizable investment, but almost an insignificant percentage of the pension portfolio. But there's only 4 pension funds in the world that have invested in gold. And in total, there's something like 340 trillion in pension fund money, and most of the pension funds are deeply underwater in terms of their commitments. So at some point in time, they'll realize they have to buy bullion, and when you have like even 5% of 340 trillion attempt to buy gold, it'll go through the roof. Just do the math.
Absolutely. It's not a small number. And why do you think so few of these pension funds have taken to gold and silver?
Well, I've struggled with that, but there's multiple reasons. First of all, the average portfolio manager today, if he's been in the business for a long time, is only 50 years old, which means he would have started as a portfolio manager in the 90s. Okay, so he doesn't have any experience in a gold bull market like the 70s. You have to be an old guy like myself to know what that's about. So that's number one. Number two, there isn't a single university other than the von Mises Institute that teaches money, currencies, etc., which I find amazing. It's like a carpenter not knowing what wood is. So all the financial advisors, central bankers, portfolio managers really have no clear understanding of what money is and the history of money and so on. And then the final thing is that to maintain the U.S. reserve status, that the main competitor to the U.S. reserve status is gold. The U.S. dollar is the strongest amongst the currencies, maybe with the exception of Swiss franc, but even that's weakened recently. But when you look at, say, devaluation of the U.S. dollar in gold terms, it's lost like 98% since 71.
Yep. So to that point, then, why do you think it's you stated that maybe some people just don't know the history of money or really what money is, but why do you think it's so hard for people to accept that gold and silver are money?
Well, I've written several articles on the myths, and there's like 6 major myths that are deeply ingrained. Like the first thing people say, well, it doesn't pay any interest or dividends. Well, neither does any currency. You put Swiss francs in a vault, it's not going to give you any interest or dividends either. You have to exchange the currency to some other forms, bonds, bank accounts, so on, before it pays either interest or dividends. So that's the first misconception that everybody applies to gold. But then, that it's volatile, it's a risky asset, it's these kind of things. So these are all ingrained psychological barriers. And I think one of the main problems is that the psychological barriers, it's complacency, normalcy bias, and one more, I always forget 3. But the 3 main psychological barriers that people just don't give it any thought out of the box. Like I find it amazing how like the pension funds are targeting for 6% returns in order to not have unfunded liabilities. And since 2000, in all the currencies, gold has averaged about 11%. So wouldn't that be obvious? And when you buy gold, because it's a negatively correlated asset, it reduces the portfolio volatility. So straight math, straight facts, simple to understand, but yet that's a particularly hard sell.
Absolutely. So going back to one of your earlier points about it being an investor safe haven. In fact, it's even in the title of the your piece. But we've recently seen a record outflows of gold ETFs, and we've seen a big transition into the Bitcoin market as Bitcoin is now reaching new all-time highs. What are your thoughts on this behavior?
Well, first of all, the in and out flows into the ETFs or trading accounts, and they're not people that are holding gold for long-term wealth preservation.
Right.
So they have a lot of volatility. I've written an article a few months ago called "The Illusion of Owning Gold," because people think that the ETFs actually own the gold, but they don't. The authorized participants borrow the gold from central bank and others, deposit it into the ETF. They get duly created shares, and they sell the shares and keep all the money. Now, the trouble with that is that the title to the gold, when you're a lessor, such as a bank, title to the gold always remains with the lessor. Just like if you lease a BMW,
Hmm.
that you get to drive it, but it's not your car.
Right.
So the problem becomes is that if you have a failure of an authorized participants, which are all the big banks, Deutsche Bank, for example, is one, then you're going to have a problem between the central bank that leased the gold and the ETF. And all the central bank has to do is call back the gold, and the ETF would have to return it because they never got title to it in the first place. So if you look at the carefully look at the prospectus and the authorized participant agreement, you'll see that they're all carefully worded to allow for that. So
Uh,
to me, I use ETFs because you can easily buy puts and calls, and that way you can hedge your physical gold holdings or enhance the returns for a relatively little amount of money.
some really good insight. We've spoken a lot now about gold specifically, but if gold is heading to $10,000, where does silver lie within that? What are your thoughts on that? The
Well,
silver as a metal.
silver is grossly undervalued right now. The normal long-term mean is about 40 to 1 in terms of easy arithmetic.
Hmm.
So currently the price of silver is about 80 to 1. So that means the price of silver would have to double just to revert to the mean today. So if gold was to go to 10,000, silver would be at least 250. I think the silver would outperform gold in the long term, like from a straight performance point of view.
That's certainly very encouraging. Many of our viewers are long-term silver enthusiasts as well as gold enthusiasts, so I'm sure they'll be ecstatic to hear you say that.
Yeah.
Now, we're about to head into 2021. What is your advice to investors looking to add gold and silver positions to their portfolio?
Well, the thing is, if you're, first of all, not speculating, if you're trying to preserve wealth in your portfolio, you need to make sure that either you own the bullion directly, which is only okay in small quantities. You're not going to have hundreds of thousands or millions of dollars worth of bullion at your house. Um, so then when you have to use a custodian, uh, there's a lot of intricacies there to make sure that A, you get the financial information from the custodian in terms of his statements, that the bullion is fully allocated, everything is documented properly. We've spent like hundreds of thousands in legal fees to get our custody agreements right to protect the investors. So that's critical once you get to the next phase. Like one of the things people don't realize is that uh, if the custodian doesn't own the vault, if it's mortgaged or leased, and they default either on the mortgage payment or lease payment, the landlord or lender can basically close the facilities and repossess anything that's inside.
Oh, that's an interesting piece of insight that I'm sure many of our viewers were not aware of. Nick, I want to say thank you for joining us today. That's all the time that we have. Are there any closing words or insights that you'd like to give for our viewers before we wrap up?
Well, if you haven't invested in gold, the first thing to start with is gain the knowledge, devote the time to educate yourself and get up to speed. And then dollar cost average in. Don't take all your money and buy it on one day, because as likely as not, you'll be long that day. So you want to virtually dollar cost average unless you're a technical expert.
Sound advice, tried, true, and tested, so to speak. Nick, once again, thank you so much for joining us, and happy holidays to you.
Happy holidays to you. My pleasure.